Despite rising inflation, major U.S. corporations are reporting record profits.
Back in the 1970s, President Ford was better known for literally and figuratively stumbling than for his economic acumen, especially when it came to inflation, which soared into double digits shortly after he took office. Biden, his advisors, and champions in the press are ignoring the tough lessons of the past by downplaying inflation or bizarrely claiming it only freaks out rich people.
Inflation. Everybody's talking about it. Robert Reich. Corporations are raising prices even as they rake in record profits.
What Ford, Biden, Warren, and Treasury Secretary Janet Yellen have in common is a failure to understand inflation's most important underlying cause, which the Nobel Prize-winning economist Milton Friedman was explaining with unique clarity back in the 1970s.
Toward understanding the cause of inflation is to recognize that it is always and everywhere a monetary phenomenon.
We've seen massive increases in government spending over the past 2 years, which have been paid for by printing money and historic increases in the money supply. And when you print money, it means that there are more dollars chasing the same amounts of goods and services, which causes prices to rise.
This isn't about inflation. This is about price gouging.
It's an inflation rate that's just reached 10% for businesses, the Producer Price Index. How come profits have risen even more?
Over the past year, companies' net margins have risen to record highs, and net margins are expected to rise again over the next year.
Wall Street Journal reporter Dion Rabowen.
Nearly 100 of the biggest U.S. publicly traded companies booked 2021 profit margins that were at least 50% higher than their 2019 levels.
In just the past 2 fiscal years, federal spending has swollen to nearly $7 trillion a year, up from about $4.5 trillion in 2019. That money has to be paid for eventually by the American people one way or another. Traditionally, that means higher taxes, cuts in services, and inflation, or a combination of the three.
The CEO of Kroger recently said,
"A little bit of inflation is always good in our business."
From Constellation Brands, which sells beer, wine, and spirits.
We're going to look at this on a market-by-market basis, brand-by-brand basis, and we'll take as much pricing as we think the consumer can absorb.
The real tax on the American people is what government spends.
And politicians generally prefer printing money to raising taxes or cutting services.
Inflation is a tax which is imposed without representation and which nobody has to vote for. And of course, it's a marvelous tax from the point of view of a congressman trying to meet the demands of his constituents for more spending.
One of my favorite examples is Tyson Foods.
Purveyor of 1 out of every 5 pounds of beef, chicken, and pork sold in the U.S. Here's Tyson's chief financial officer on their latest quarterly results.
Our pricing actions led to approximately $2.1 billion in sales and price mix benefit during the quarter, which offset the higher cost of goods sold of $1.6 billion.
Politicians and government economists will even claim that the way to drive down inflation is by handing out more goodies.
Yeah.
What this package will do is lower some of the most important costs, what they pay for health care, for child care, and it's anti-inflationary in that sense as well.
Capitalism requires greed to run.
Economist Noah Smith.
Corporations are always greedy. Their greed dial is always set to absolute maximum. And the idea that ameliorating greed would have any effect on inflation is wrong.
Who Found Greed explains the inflation surge with a tongue-in-cheek greed index chart.
And I labeled the rises in inflation as rising greed and the drops in inflation as falling greed.
Which would imply rising corporate generosity.
The reason this is a joke is because the big drop in inflation in the 80s would have to be caused by surges in corporate altruism, the altruism of Gordon Gekko and the 80s people.
When the president and his advisors touted the passage of his $1.2 trillion infrastructure bill and promised that even more was on the way through the Build Back Better bill and other legislation, they insisted that spending more money will somehow make everything more affordable by increasing long-term economic capacity.
According to economic experts, this bill is going to ease inflationary pressures, lowering the cost of working families. 17 Nobel laureates in economics wrote a letter to me saying this is going to bring inflation down, not up.
That's precisely backward, because the government will be printing even more money to pay for Biden's bill.
Opportunity is the cover of inflation.
Aha. The opportunity caused by the pandemic.
But in reality, companies aren't being forced to raise prices because of inflation. They're raising prices because they can.
As the government borrows more money to pay for its spending and the Fed prints money to buy that debt, the central bank's balance sheet has more than doubled between March 2020 to November 2021. The result is that the supply of dollars has increased by nearly 40% over the past 2 years, which is an off-the-charts record.
Inflation sort of disguises these price increases. When prices for everything around you are rising, it's much easier for companies to raise their prices and not experience that consumer blowback.
The point is, when consumers come to expect inflation, the process can begin to feed on itself.
Companies know that consumers expect higher prices right now, and they're really seeing how far they can push that.
But there's no reason to believe that Joe Biden or anyone else in Washington is committed to the type of fiscal and monetary discipline that would actually tame inflation.
And says Robert Reich, Wall Street is egging them on. saying,
look, this is a great time to raise your profit margins. And of course, those Wall Streeters are saying the same thing to everybody else in the industry.
In fact, his infrastructure bill jacks the very entitlement spending that is the major driver of long-term spending. Not only is he trying to expand access to and coverage offered by existing programs such as Medicare and Medicaid, he's pushing for tax credits for parents and new entitlements for childcare and universal preschool.
75% of all American industries have become more concentrated in the last 2 decades.
Most are now dominated by a handful of corporations that coordinate prices and production. This is true of banks, broadband, pharmaceutical companies, airlines, meat packers.
You got 4 basic meat packing facilities, and you pay a hell of a lot more because there's only 4.
Customers will note that there is almost an exact price matching among all major so-called competitors because they're not really competing.
Another thing that's changed over the past 40 years is that the publicly held debt has more than quintupled as a share of GDP. In 2022, the Congressional Budget Office predicts that interest payments on the debt will be 5.7% of total spending, and then it will more than double to 11.6% by 2031. And that's assuming interest rates stay low. Squeezing inflation out of the economy by hiking interest rates is never a popular political stance. Since it will absolutely devastate the government's balance sheet, it'll be even harder this time.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later.
So, what is to be done?
Tonight, I'm announcing a crackdown on those companies overcharging American businesses and consumers.
A crackdown on the shipping industry by regulators.
If they identify that there is market manipulation or price gouging going on.
The president's national economic advisor, Brian Deese.
And the agencies have now committed to partnering, where the Department of Justice has significantly more enforcement resources and investigatory resources.
This is a new landscape. It's a brave new world in the best of ways for us to respect the Constitution as the new Supreme Court has told us that we must. That quite literally means that potentially a majority of existing federal regulations, as they exist on the books, are unconstitutional based on what the Supreme Court has already told us. As I said before, if we don't get this job done now of taming and downsizing our federal regulatory state, the body of federal regulations, the bureaucracy that goes along with it.
And the administration says it's working to lessen concentration in the food sector, too.
You need scale to be competitive, and it takes capital to get to scale. So the USDA is actually right now working with smaller processors in rural areas across the country to try to give them grants, give them low-cost capital so that they can scale, they can get into the game more quickly and easily.
As the meat industry points out, though, it's been concentrated for decades. Meanwhile, with company costs rising at about 10%, corporate profits are rising at 12.4%.
If we don't get it done now, we never will. But I assure you, this is why we are here today. This is what President Trump was given a mandate to do by the American people. It was not a mandate for incremental reform. It was a mandate for sweeping reform. And that is what the voters actually deserve. Now, there will be those who ask, well, what happens when the federal government is drastically downsized? You take the scope of the regulatory state, the bureaucracy to go along with it, all of the waste, fraud, abuse, spending that often wasn't even authorized, that's going out willy-nilly out the door. What happens after that's downsized?
Dr. Greenspan, I want to start with you. You were the longest-serving chairman of the Federal Reserve in history, and during this period of time, you were perhaps the leading proponent of deregulation of our financial markets. Certainly, you were the most influential voice for deregulation. You have been a staunch advocate for letting markets regulate themselves. Well, where do you think you made a mistake then?
I made a mistake in presuming that the self-interest of organizations, specifically banks and others, was such as that they were best capable of protecting their own shareholders and their equity in the firms.